Well, here we are in our final presentation for Chapter 3, our Introduction to Stocks. And in this final presentation, we'll be discussing investment strategies. And we'll see that there are several and a few that you should really stay far away from. And we'll start with my personal favorite, buy and hold. We use fundamental analysis. Now, what's that? Relax. That's what we're going to discuss in detail over the next two chapters. We've already made a little bit of reference to it. That's the analysis of the company as a business. You use fundamental analysis to identify high-quality companies with good prospects and potential for dividends at reasonable prices, and you hold them for the long term. What's long term? 5, 10 years or so, maybe less than 5, depending. We'll discuss the magical 3, 4, 5-year time frame. That doesn't mean you only hold it for that long. That's how far we could possibly, just possibly, even begin to think in terms of how far out we want to look. It's sometimes called value investing, sometimes called growth at a reasonable price. And Warren Buffett was once asked, well, what's your favorite holding period? He said, our favorite holding period is forever. Now, he was being a little playful, little facetious, because you don't live forever, obviously. But it makes a lot of sense. It makes a lot of sense in that if you buy a business, just because the price has gone up 10% or down 10% or whatever, you don't turn around and sell it, right? No, you hang on to the business, and eventually you're going to want to sell. Maybe you're nearing retirement and it's time to cut back, and you want to sell or maybe you keep it in the family and bequeath it to somebody else. But you hold on to the businesses because they're still in decent shape. They're making money. And as Jack Bogle said, you hold on to them. That's what we've done in time immemorial. My personal favorite strategy is buy and hold. So I'll tell you right off the bat in terms of my bias. And it's also one of the easier ones to do because you don't try to decide whether now is a good time to invest. Maybe now is a good time to sell. You just hold on, and when the market hits the skids, when the organic matter hits the ventilating device, you hunker down and maybe even buy some more. So let's take a look at this one example that I like called Don't Lose Perspective. Okay, I got it queued up here. Let's make sure I don't screw it up here. Here it is. Don't lose perspective. Both of the charts, there's two charts. We're going to just look at the first one, show what happened to global stocks between 1990 and 2000. What's the difference? The investor's perspective. So here's the short-term perspective. It shows you the month-to-month percentage returns. Is there any rhyme or reason? No, there's no way for you to decide what's going to happen next. For investors with a short-term perspective, the market can be unbearably rocky. But if you simply extend your time horizon, here's that same chart, the same, but this time it's year to year. It shows how the effects of short-term fluctuations can look quite different when you keep a long-term perspective. And I think I have told you on numerous occasions that you do need to think long-term, because if the world does end, what happened to my, it disappeared. Here it is, it's back again. The closed captioning. If you do try to time the market, if you do try to get in and out, try to decide, oh, the market's going to fall, oh, the market's going to go up, all I can say is I wish you a lot of luck, because it isn't easy. And all the studies have shown we can't determine the market's direction in the short term. There are people who tell you they can. They might be fooling themselves or they might be trying to fool you. Either way, we'll see. When we get to market timing, we'll see that wonderful quote by Bernard Baruch. The income strategy, sometimes called the equity income, remember from chapter 2, equity income mutual funds? These are investors who emphasize dividends over capital appreciation. Ideally, in my humble opinion, you want to be looking for growth of dividends. Because as we've noted, companies that pay consistently growing dividends tend to do well when the market as a whole does poorly. In general, these are appropriate for conservative stock investors. Again, not politically conservative, but fiscally conservative. They want to not lose the money. So you remember the income-oriented stocks? Right. Blue chip companies works really well with dividend reinvestment plans, DRIPs. These stocks that have had long histories of consistent dividend increases have often been the market's best long-term investments. I like the income strategy. It works well with buy and hold. Now, the growth strategy is the strategy that many people employ. If you get involved with betterinvesting.org, a group that's been around since the early 1950s, what's going on? The closed captioning keeps disappearing. I'm not sure what's going on. My apologies. You invest in stocks with above average forecasts of earnings growth. Dividends are a secondary concern. It seems to be happening again. Here it comes back. Okay. Dividends are a secondary concern. Usually these stocks have high price to earnings ratios in expectation of higher earnings in the future. Look, growth stocks are the stars, they're on the cover of Vogue and Vanity Unfair and Gentleman's Quarterly. Everyone wants to jump on the bandwagon as a company is experiencing strong growth. Consequently, subsequently, the stock prices are bid up to very high levels. And these are the stocks that tend to be the riskiest. The parachutes had better be very, very large. When the slightest hint of a slowdown in the growth appears, the stock price is often brutally punished. For those of you who are math fans, remember the first derivative and the second derivative? Yeah, they look at the second derivative. And if you don't know what I'm talking about, don't worry about it. They look at the rate of the growth of the growth. And folks, it was hard to argue with growth strategy investors since the global financial crisis because growth was where it's at throughout the 2010s. Everybody looked like a genius who was investing in growth until 2022, when many of the growth stocks hit on hard times, and the value stocks. 2022, the stock market, as measured by the Standard & Poor's 500, lost about 18% or so. Growth stocks lost 30 or more percent, but the income-oriented, boring stocks only lost 5 to 8%. Right, because people all of a sudden realized, hey, dividends don't lie. Now, this next category is, we call it the aggressive growth or speculation or short-term trading. I think this is the strategy that many people think they're supposed to use when they start investing in stocks. Look, folks, it is fraught with peril, drawbacks, not the least of which are the serious transaction costs that can be generated as a result of frequent trading. Stockbrokers simply adore the suckers. Traders who use this strategy. And if you give me that, I don't pay any commissions because I have Robinhood stuff, go back and look at the third presentation because you are being charged. You've seen the photos of somebody with 4 computers and 3 screens and 2 telephones at the same time making trades. No. That's not for us. The investor aggressively trades in and out of stocks in order to achieve eye-catching returns. Instead of waiting 3 to 5 years for a stock to move, an aggressive stock trader would go after the same investment in 6 months, in a year, maybe 6 weeks, maybe 3 weeks, maybe 10 minutes. The image of the day trader, and to which Warren Buffett said, if you wouldn't want to own a stock for 10 years, don't think of even owning it for 10 minutes. So some traders, weeks, days, hours, minutes, but we've already saw you're up against the high frequency trading firms who have millions of dollars to hone their technology and trade millions of shares each day. So if you thought you were going to outgun these people, think again. You're coming to the fight with a knife and they have bazookas and tanks. I don't know if that's a good analogy, but it's the same idea, folks. You're just totally out resourced. So don't even think about it, in my humble opinion. And of course, other people are going to say, oh, just use our surefire method. We'll show you, and it only costs you $9,995 for the 5-week session to learn how to trade like a pro. And right. Anyway, slide number 89. Now, this strategy is actually a bona fide strategy, but it ain't easy. It's called contrarian strategy. Investing in stocks that are out of favor with the market for some reason, as reflected by low price to earnings ratios and low prices compared to their fundamentals. Remember the term value we talked about in the previous presentation? Contrarian investors actively seek stocks from companies with sound financial statements that the market has undervalued for whatever reason. A very famous contrarian said it this way: I always try to be accommodating. I buy when others want to sell, and I sell when others want to buy. Now, the problem is it isn't easy. The market tends to go up 3 times more often than it goes down. So what good contrarians do is they simply sit on their hands and wait for those times when there's blood in the streets. It's a famous quote from Baron Guy de Rothschild. You buy when there's blood in the streets. And Howard Marks, another famous contrarian, said it this way: it's not a steady business. So throughout the 2000s, Warren Buffett, who's a contrarian, sat on his hands as the market was going up and just said, we're not interested. And then when we had the global financial crisis in 2008 and 9, he swooped in, bought $5 billion worth of Goldman Sachs, $5 billion worth of GE, $10 billion worth of Bank of America. Right, you wait until the organic matter hits the ventilating device, until there's blood in the streets. And as Mr. Mark says, it's not a steady business. You have to be patient. But the rewards can be very great because you're buying when everybody else is selling. And selling, though, is the harder part. You want to sell when others are going into a mania. So it's not easy. As we said, it's not easy. I don't really consider myself a contrarian. I've done a few contrarian moves in the past, and they've worked out okay. But I don't put myself in the same leagues as Mr. Marks or Mr. Buffett, that's for sure. Slide number 90. Now here we should call these Tweedledum, Tweedledummer, and Tweedledummest. Buy stocks in hot sectors, sell stocks in stale ones. It's called sector rotation. And you'll hear people on the telly and the infernal net, on the websites, the talking heads, the pundits, talking about rotation from one sector to another sector, or from growth to defensive, or from cyclical to growth, or whatever. Don't do it. You have to determine which sectors are hot, which sectors are stale, and you'll be waiting for that sector to get hot when it's actually stale, and then you'll finally give up and move it to the hot sector that turned stale just as the stale sector turned hot. Momentum investing uses what's called the greater fool theory. You buy stocks as they go up, you sell stocks as they go down, and you might use some techniques that we'll talk about way at the end of the semester to make money when stocks go down, which is very dangerous, called shorting. It's the greater fool theory for a reason, folks. Somebody out there is a greater fool than I am. And this is what the cryptocurrency folks are doing. Cryptocurrency folks are doing. They are using momentum investing. They are hoping somewhere that there is a greater fool than they are when they buy something that basically isn't worth anything. So, are you going to be a momentum investor? It's not really investing, it's speculating, it's trading. We wish you a lot of luck. You'll need it. And then market timing, folks. Here is that wonderful quote by Bernard Baruch. Don't try to buy at the bottom and sell at the top. This can't be done except by liars. The same people who say the fish was that big, the fish that got away. They're lying to themselves. You're attempting to predict the future direction of the market. And look, it's hard enough to get it right once. You got to get it right twice. You got to get it right before the market falls, and then you got to get it right when the market's going to go up. Good luck. And I've seen market timing strategies that have been touted. They essentially backdated the model to work in the past. Well, great. That's the past. What's the future going to be? Well, you just don't know. And one time, believe it or not, your humble instructor was called upon to be an expert witness of a gentleman who had created one of these market timing schemes. And sure enough, it was backdated to work. And I just said to the lawyer who was in charge, who was paying me a handsome sum, thank you very much, that I thought that this is great if you could somehow turn back the clock and go back 20 years and use the model, because you already knew what was going to happen 20 years ago. But I don't have any conviction that it's going to work in the future. And she just looked at me and said, okay, thank you very much. Here's your money. Thank you very much. And the judge, I guess, agreed with me. I heard afterwards. I didn't hear the whole disposition of the court case. But yeah, don't try to time the market. It can only be done by lawyers. And dear students, which strategy do you favor? Now, I've already tipped my hat, right? I've already told you that I love buy and hold. I'm a buy and hold kind of guy. But hey, maybe you will join the Better Investing group and think growth is the way to go, and good luck to you. Maybe you'll be a buy and hold income investor. We hope you don't try aggressive growth investing. Maybe you want to become a contrarian and sit on your hands and wait until the blood flows in the streets. But with regard to sector rotation, momentum investing, momentum trading, we should really call it, and market timing, we hope you stay far, far away. Slide 92. We're done. And a lot of work, isn't it? A lot of material for you to study, folks. Study every day, because you are now rising investment gurus. And you are ready. Oh boy. We're ready to enter the temple of valuation models, fundamental analysis, where we're going to learn techniques that most people have never heard of. They're not really that hard, actually. And we will learn how to tilt the odds in our favor toward long-term, prudent investing. And you will be, after Chapter 4, fundamental analysis, valuation models, you will be official investment gurus. We're so proud of you. Study every day, all right? Think of how much you've learned. Internalize the study, the material, and be awesome. We're so proud of you folks. Thank you so much for being in our class. Everyone at Southwestern is grateful, honored, privileged, and happy you are with us. We wish you much success.